Good afternoon, everyone. Welcome, and thank you for taking the time to be here. Since the previous meeting of the Monetary Policy Committee, inflation has breached the upper end of the target band and is expected to remain outside the target for some time. This development was in line with the bank's inflation forecast, which is more or less unchanged since the previous MPC meeting. The exchange rate has appreciated somewhat since its lows in January in response to a more benign global monetary policy environment, moderating some of the near-term upside risks to inflation. Nevertheless, risks to the inflation outlook remain skewed to the upside. Despite a more favorable global growth environment, the domestic economic growth outlook has deteriorated markedly. There is still no end in sight to the protracted strike in the platinum sector, and the economic and social costs are escalating and are potentially devastating. Both the mining and manufacturing sectors appear to have contracted in the first quarter, with electricity supply constraints adding to the weak outlook. Against this backdrop, monetary policy faces an increasingly challenging scenario. The year-on-year inflation rate as measured by the Consumer Price Index for all urban areas measured 6% and 6.1% in March and April 2014, respectively, up from 5.9% in February. Food and non-alcoholic beverage price inflation accelerated significantly, measuring 7% and 7.8% in the past 2 months, compared with a recent low of 3.5% in December. The contribution of this category to headline inflation was 1.2 percentage points in April, compared with 0.8 percentage points in February. The categories of food, housing, utilities and transport together accounted for 3.7 percentage points of the inflation outcome in April. Core inflation, which excludes food, petrol and electricity, measured 5.5% in both March and April, after 6 consecutive months at 5.3%. Administered price inflation, excluding petrol, continued its gradual decline, measuring 6.5% in April, from 6.7% in March. The headline producer price inflation for final manufactured goods measured 8.2% in March, compared with 7.7% in February, driven mainly by food prices, and is indicative of further upside pressures on CPI inflation in the near term. The bank's forecast of headline inflation changed marginally since the previous meeting. Inflation is expected to average 6.2% in 2014, compared with 6.3% previously, with a peak of 6.5%, previously 6.6%, expected in the fourth quarter. The forecast average inflation for 2015 remained unchanged at 5.8%. The forecast horizon has been extended, and inflation is expected to average 5.5% in 2016 and 5.4% in the final quarter of that year. Inflation is still expected to remain outside the target band from the second quarter of 2014 until the second quarter of 2015. The outlook for core inflation is also largely unchanged. This measure is expected to average 5.6% and 5.7% in 2014 and 15 respectively, compared with the previous forecast of 5.6% for both years, moderating to 5.5% in 2016. The upward pressure is assessed to be a response to the lagged effect of the exchange rate depreciation, rather than evidence of strong domestic demand pressures. The MPC still sees the risks to the inflation forecast to be skewed to the upside, and remains concerned that the current low level of pass-through may not persist. The Reuters survey of inflation expectations of economic analysts conducted in May is more or less unchanged since the previous survey. Inflation is expected to average 6.3% in the second quarter and 6.2% in the final 2 quarters of this year, before returning to within the target at an average of 5.8% in the first quarter of 2015. Annual inflation is expected to average 6.2% in 2014 and 5.6% and 5.4% in the subsequent 2 years respectively, somewhat lower than the bank's forecast. The global economic outlook remains mixed. Growth in the U.S. stalled in the first quarter as a consequence of the severe weather conditions, while retail sales in April were below expectations. Despite downside risk to growth from the housing market, the recovery is expected to remain on track, although at a lower rate than that forecast earlier in the year. While the Fed expects growth of between 2.8 and 3% for 2014, the market consensus is closer to 2.5%. The UK economic recovery also appears to be resilient, despite some slack in the economy. By contrast, the Eurozone continues to lag, following a lower than expected annualized growth rate of around 0.8% in the first quarter. The annualized growth rate of 5.9% recorded by the Japanese economy in the first quarter of this year is not expected to be sustained, as higher consumption taxes take effect, and consensus forecasts offer an annual growth of around 1.5%. The Chinese economy grew at an annualized rate of 5.8% in the first quarter of 2014, amid weakening trends in industrial production and retail sales. Although an annual growth rate of between 7 and 7.5% is still generally expected, there are concerns that the loss of momentum in the property market and declining credit growth could pose downside risks to growth. The shift in global growth dynamics towards the advanced economies has been reinforced with a number of emerging markets facing a more challenging outlook. Low growth is expected in a number of the larger economies, including Brazil, Russia, Argentina, Turkey, and Thailand. But some analysts have revised upwards their growth forecast for India. More positively as well, growth in sub-Saharan Africa is expected to average 5.4%. But this is vulnerable to weaker commodity prices in the event of a slower growth in China. Global inflation remains benign amid relatively stable food and energy price trends. Financial markets appear to have priced in continued steady tapering of QE in the United States, and recent guidance from the Fed appears to have reduced the degree of volatility and uncertainty in financial markets regarding the pace and timing of monetary policy normalization. Policy rates look set to increase at a moderate pace in the US and UK during 2015, while the possibility exists of further easing in Japan and the Eurozone, where the risk of deflation persists. Since the previous meeting of the MPC, monetary policy has been tightened in New Zealand, Brazil, and Russia in response to inflation pressures or exchange rate concerns, but has eased slightly in Hungary. With global financial markets pricing in a slower pace of US policy normalization, global risk appetite has improved. Apart from sizable outflows from Russia in the wake of the crisis in the Ukraine, capital flows to emerging markets have resumed, or outflows have slowed, resulting in generally appreciating emerging market currencies and declining long bond yields. This improved sentiment has also impacted on the rand exchange rate, which appreciated by 3.3% against the dollar and by 3.1% on a trade-weighted basis since the previous meeting of the MPC. During this period, the rand traded in a range of between 10 Rand 70 and 10 Rand 29 against the US dollar. Portfolio flows to South Africa have been in line with general global trends. Following cumulative net sales of South African government bonds and equities by non-residents of 71 billion rand from November 2013 to the end of January 2014, net purchases of bonds and equities since the beginning of February have totaled 8.3 billion and 29.9 billion respectively. Year-to-date, net inflows into bonds and equities have totaled 7.6 billion. While recent exchange rate developments have afforded some near-term respite from further inflation risk from the exchange rate, the MPC is mindful of the sensitivity of the rand to both global and domestic factors. The rand is expected to remain vulnerable to changing global perceptions of US monetary policy and associated capital flows. However, while the recent appreciation is more a reflection of changing global risk perceptions rather than a specific reassessment of South African fundamentals, domestic factors have also impacted the rand. The exchange rate is likely to remain sensitive to domestic factors, including developments in the current account of the balance of payments and perceptions of its sustainability. In particular, the ongoing strike in the platinum sector is expected to begin to have a significant negative impact on exports now that inventories are reaching low levels, and a further extension of the strike could impede the required current account adjustment process. The domestic economic growth outlook has deteriorated markedly, with a reversal of a number of the tentative positive signs observed at the beginning of the year. The bank's forecast for economic growth for 2014 has been revised down from 2.6% at the previous meeting to 2.1%, implying a further widening of the negative output gap. The forecast for 2015 remains unchanged at 3.1%, and growth in 2016 is expected to average 3.4%. However, the risks to these forecasts are increasingly to the downside against the renewed possibility of electricity load shedding, among other factors. The bank's leading indicator of economic activity declined marginally in February, and the sustained sideways movement confirms the subdued outlook amid weak business confidence. The RMB-BR Business Confidence Index declined by 2 index points to 41 index points in the first quarter of 2014. The first quarter growth outcome was negatively affected by contractions in both the mining and manufacturing sectors. In the first quarter of 2014, the physical volume of mining production declined by 6.8%, not annualized, when compared with the previous quarter. This decline was not confined to the platinum group metals, with production declining in 7 of the 12 mining subcomponents, and expectations are for this negative trend to continue. The physical volume of manufacturing production declined by 1.6%, again not annualized, in the first quarter of the year. The contraction was also broad-based, and the outlook for the sector remains subdued, as reflected in the marked decline of the Kagiso PMI to 47.4 index points in April. This follows 2 consecutive months when the index was above 50 points. The new sales orders component of the PMI remained well below 50 for the second consecutive month. There appears to be continued underutilization of manufacturing production capacity, particularly with respect to durable goods production. The favorable trend in the real value of building plans passed during the past 2 years has been maintained in keeping with the rising levels of building confidence. The real value of building plans passed increased by 13.6% on the 3-month to 3-month basis in March 2014 and by 5.9% on a year-on-year basis. The unemployment rate remained elevated at 25.2% in the first quarter of 2014 in a declining growth environment. This follows a decline in employment in the first quarter of 2014 of 122,000 jobs, although on a seasonally adjusted basis, the decrease was 32,000. Consumption expenditure by households is expected to remain constrained in the face of continued weakness in credit extension, rising inflation, high consumer indebtedness, as well as the knock-on effects of the mining strike, where the cumulative loss of wages is estimated to have exceeded 8 billion rand. Real retail sales grew by 0.6% on a quarter-to-quarter basis in the first quarter of this year, having declined in March by 1.4% on a month-on-month basis. New vehicle sales declined by 0.7% on a 3-month to 3-month basis in April, and by over 10% on a year-on-year basis, while NAMSA expects new vehicle sales to contract over the year. Although the FNB-BR Consumer Confidence Index improved marginally in the first quarter of 2014, it remained at a low level of -6. Growth in bank credit extension to households continued to moderate, while that to companies has remained relatively robust. The 12-month growth in total loans and advances to the private sector measured 8.2% in March 2014, driven by a 12.7% increase in credit extension to companies, related in part to the awarding of a new round of renewable energy contracts. By contrast, growth in credit extension to households moderated further to 4.8%, as unsecured lending continued its downward trend. Growth over 12 months in general loans to households, mainly made up of unsecured lending, measured 3.5% in March, the lowest rate of growth since 2005. Growth in mortgage advances to households remained below 3%, in line with a relatively subdued volume growth in the housing market. While growth in installment sales and leasing finance recorded an annual growth of 10.1% in March, it is on a declining trend, particularly with respect to households. These trends in credit extension are expected to remain a constraint on consumption expenditure growth. The trend in wage settlements is more or less unchanged. According to Andrew Levy Employment Publications, the overall wage settlement rate in collective bargaining agreements was unchanged from the previous year at 7.9% in the first quarter of 2014. However, the main wage negotiations are yet to be completed, in particular the renegotiation of a new multi-year agreement in the Steel and Engineering Bargaining Council. The outcome of this, as well as the impasse in the platinum sector, could have an important bearing on the general trend of wage settlements. Food prices remain a risk to the inflation outlook, although the risk may have moderated somewhat following the sharp reversal in domestic maize prices in recent weeks. Having reached a peak of almost 3,800 rand per tonne in March, maize prices declined in May to around 2,000 rand per tonne, and an 8% decline over the year. This was in response to an upward revision of the domestic maize crop forecast, now expected to be 11% higher than last year, which has resulted in a move from import to export parity prices. This development, if sustained, would help ameliorate the considerable pipeline pressures that have been evident in the producer price index since the beginning of the year. Final manufactured producer price inflation accelerated to 9.1% in March, and further pressures are evident in the agricultural producer price inflation for cereals, which measured 26.5% in March, although this is expected to moderate in response to lower spot prices. The international oil price has remained within the range of 105 to 111 US dollars for some time. The domestic price of petrol has benefited from the stronger trend in the exchange rate over the past weeks. In May, the price of 95-octane petrol declined by 15 cents per litre, following a 7 cents per litre increase in April. And, should current trends continue, a further reduction can be expected in June. The MPC continues to face the difficult dilemma of dealing with upside risks to inflation and a deteriorating domestic economic growth outlook. Although the breach of the upper end of the inflation target band was in line with the bank's forecast, the risks to the forecast remain to the upside. The policy dilemma is increased by the fact that inflation is seen to be driven primarily by supply-side factors, while demand conditions in the economy remain subdued. Although the immediate pressures from the exchange rate are lower than was the case early in the year, the exchange rate remains a significant source of upside risk to the forecast. The respite from the stronger exchange rate could be temporary and respond quickly to changes in both domestic and external conditions. Although the pass-through from the exchange rate to inflation is still relatively low, there are indications of some acceleration. In addition, food prices are expected to add further upside impetus to inflation in the near term, but this risk may have moderated to some extent given the sharp decline in the maize prices and the low global food inflation. As indicated earlier, the bank's economic growth forecast for 2014 has been revised down significantly to 2.1%, and the first quarter growth outcome is anticipated to be the lowest quarterly growth rate since the recession in 2009. Although growth in the second quarter is expected to improve somewhat, the risks to the 2014 growth forecast are strongly on the downside, with developments in the mining sector an ongoing cause for concern. The demand side of the economy is also weakening. Household consumption expenditure growth continues to moderate amid slower credit extension to households, high levels of consumer debt levels and moderate job growth. However, the weak state of the economy cannot be resolved through monetary policy actions alone. The committee continues to hold the view that we are in a rising interest rate cycle, and interest rates will have to be normalized in due course. We embarked on this process with our first move in January 2014. At this stage, the pace and timing of normalization in the advanced economies appears to have been pushed out further and may be more moderate than previously believed. We are also aware that this can change very quickly. Accordingly, the committee decided to keep the repurchase rate unchanged at 5.5% per annum at this stage. Future actions will be data dependent and determined by developments in the inflation outlook and inflation expectations. Inflation is currently at uncomfortable levels, and a marked deterioration in the outlook may require action that we will not hesitate to take. The MPC reiterates that a rising interest rate cycle does not mean that rates will be raised at each meeting or by the same amount each time. Thank you. I'm happy to take any questions that you may have, and MPC members are, as always, I hope, ready to respond. Anyone? Go for it, Frans.
Governor Franz Wild from Bloomberg. Maybe we could get the formalities out of the way first.
It was not a unanimous decision. It was a decision of 5 members wanted to hold and 2 members wanted to raise.
A slightly different question. Obviously, we've just had elections and new cabinet's about to be announced. Given your rather gloomy outlook on the economy, what would be your tips to the incoming finance minister?
My tips will wait for the ears of the finance minister. I would say let the process unfold as it is designed to. On Sunday, I'm assuming, according to all reports, we'll know who the entire cabinet is. And I think it's in that context that I'm quite sure there would be an interaction between the bank and the appropriate ministries or the people responsible. And we look forward to that. But I certainly would not want to give them tips at this point in time. Yes.
Afternoon. Governor, you're saying that you're facing a policy dilemma, which is made worse by the fact that inflation is driven primarily by supply-side factors. So if you had to raise interest rates again, would those address the supply-side constraint?
Well, the objective of raising interest rates would be really to deal with the second-round effects and to see that that does not take hold. It's not necessarily that you would be able, through that interest rate, to address the supply-side shock, so if it's food prices or oil prices, but it's the impact of that further into the economy and dealing with second-round effects. And ensuring, I mean, what is the objective as well is to ensure that expectations are anchored. We are concerned, I mean, they seem to be reasonably well anchored, but at the upper end of the band. So it would be a number of factors that we would take into account. And as we've said, we are in a cycle of raising. Yes, sir.
Governor, you said in the statement that the quarterly GDP released next week could be the worst since 2009. Do you think it will, in fact, be a contraction? And then a follow-up question.
I didn't quite say that. I think what we said is our expectation is that the quarterly numbers are likely to be among the worst since the recession. I don't know what, I mean, the release of the data on by Stats South Africa will tell you what it would be. Obviously, some of the numbers have come out and I've reflected in mining, manufacturing and so on as to what we've seen in the actual prices that have already been public. As to what it would mean, let's wait for Stats South Africa's numbers. Can I just remind everybody also just to introduce yourselves, because there are people who are listening and just need to know the names of who's speaking. You want to follow up?
Sorry, I'm Patrick McWherty from the Wall Street Journal. And my follow-up then, you mentioned at the end of your statement that monetary policy can't solve these issues that the economy is facing alone. What more could the government do? What could the new government do to address some of these challenges?
That's another version of the same question. What would they do? I think that, you know, in essence, you've already got a government commitment to implementing the National Development Plan. And obviously, the conditions that prevail both globally and domestically must inform the approach that you take for South Africa. Our own view is it's a combination of fiscal and monetary, macro and micro, that needs to work together to ensure that we get the best results for this country. And I have no doubt that there's a great deal that we can do that is South Africa specific that can address some of the issues that we face. Yes, sir.
Tshepo Moai, SABC. Since the previous interest rate hike, would you say, have you seen any behavior or pattern in the economy that perhaps you can attribute to the rate hike? Because in an environment where the economy is weak, can you tell whether the weakness in the economy, to what extent can be attributed to a hike or general subdued economic condition?
Oh, I think that, you know, subdued economic conditions and the rate hike, I wouldn't think that the one is cause and effect. A rate hike takes time to work through the system, and I think that we can certainly look at the issues, and I'd ask my colleagues to respond to that. But I wouldn't make it, oh, we've had a rate hike, therefore you've got poor numbers. I think that would be a stretch too far, without any question. There are a lot of real issues in this economy that need to be dealt with. But anyone would like to respond to that? Francois?
Governor, maybe I just want to add the reality of it is that real interest rates are negative or very close to zero, which is, of course, very accommodative monetary policy stance that has prevailed.
And obviously, this takes the horizon for a work-through on changes in interest rates is forward-looking. It's 12 to 18 months to take an effect. Others, anyone else want to add? Other questions? Oh, you're very quiet today, aren't you? Yes? No? No? Anyone online? Okay, Peter's giving us a break this time. Okay. Anyone else? Thank you all very much. We look forward to seeing you at the next meeting, and thank you for taking your time to be here today. Colleagues from the MPC, thank you very much for your contributions, both to the discussion and today. Thank you all.